Hey guys, let's see here. Thanks for joining the stream that I'm going to be doing this morning. It's not going to be on any analysis of Bitcoin. What I'm going to be discussing is a strategy that it does have a little bit of complication behind it, and so this isn't something that I would recommend any new traders do. This is something that only experienced traders should take practice in. And what this is going to be discussing today is going to be it's going to be hedging, and I'm going to talk a little bit about how I hedge whenever I do a hedging position on a trade. Talk about different ways that it can be done, and kind of going through my thought process as I'm going through this. So first off, of course, this isn't financial advice. I'm not your financial advisor. I'm here just giving my opinion on things, just kind of talking through my strategy, which may be different than industry standards. This is just what works for me, and what works for me may not work for you, and that's okay. That's part of trading. If there's too much confluence, then trading wouldn't work for anybody if everybody's doing the same thing. So let's go ahead and take a look at this here. What I'm taking a look at, a chart here on Bitcoin. I'm looking at the daily chart. I'm looking through basically the bubble pop in 2017 down to the accumulation zone down here at the bottom of 2018, and then of course our internal retracement to the 618 here in June of 2019. So sometimes when traders get they get too overly ambitious about a position. So let's just say, you were able to short here at 20K. Let's say you were one of those few that were able to short here at 20K. Let's say you were able to short that on the perpetual swap contract on BitMax. So perpetual meaning there is no expiration. That's kind of important for the analysis that I'm going to be talking about today. So if you're able to short at 20K, right at the very top of the bull run at the end of 2017, that's a fantastic position, right? That's a position that not many people would be willing to let go of. Okay, so let's say that you do get this short up here at 20K, and basically what you're going to be expecting then, you're going to be expecting there to be like a huge retrace, right? So if you're looking for for this to finish its way down here at like 2000, down here at 1700, you're basically looking at $2,100 as our target for this move, right? On a log scale, you're looking at $2,100 for the target of the correction based on where our other pivot was, okay? So let's say you have a short from 20K, all right? And let's go ahead and go back down to a daily time frame. Let's get off of log scale, and let's move ourselves back to 2018, all right? So once you get this, you can tell that we have some technical targets that we were taking a look at here. So you're up here short from the top. You're short from say 19,500, something like that. Then you use your normal trading tools on a shorter time frame to determine where things are going to bounce. And when we talk about hedging, what you're going to be looking for is you're going to be looking for when the move goes against your position. Okay, so again, we're going to be taking a look at this, and we're saying, all right, well, we had a nice move down, and then we had another move up, and so what we're going to be really targeting here, we're going to be targeting on this this move, on this pattern here, you're going to be targeting the 1, 2, 3, 6. This is very important. I'm going to talk about why this is important here in just a little bit. Okay, so you're going to be expecting there to be a bounce at the 123.6 because when you have a correction, when you have an ABC correction, and again, we just saw this in Bitcoin just last week, and I'm going to talk about that again. I'm going to talk about that here in just a moment. But basically, what you're going to be looking for is you're going to be looking for your first move. You can call it a 1, you can call it an A. In this case, I'm calling it an A. Your second move, which is going to be your B, and then your next move is going to be all the way down here, and you're going to be targeting this 123.6. Sometimes it stops at the 100, sometimes it stops at the 123.6. Honestly, sometimes it stops at the 618. In this case, this was a very strong move down, very strong downward movement. And then you had another attempt, up here at about 17,000 where you could have re-shorted, right? Now again, that gets into even more advanced trading techniques. I'm not going to talk too much about that, but nonetheless, where you have this dominant pivot high, this dominant pivot low, and then your next pivot to the upside. Again, you're going to be targeting this 123.6. It's been sitting out there. It literally had been sitting there since January 6th and didn't hit until I think February 6th. February 6th. So a month later, you had a whole month that you had to wait. You had to have patience for this to hit, okay? And then, so now comes the hedge, all right? So let's say you've been short, okay? You've been short from up here. Let's just say that you didn't have, really great entry. Let's say you shorted at 19,000, okay? So you shorted around 19,000. You're targeting, basically the 200 weekly exponential on a a higher time frame, because again, that's going to be your high probability zone to end a bear market. Okay, to end a bear market, you're going to be targeting the 200 weekly exponential or the 200 weekly simple, whichever one you prefer. The 200 weekly is going to be pretty important. But now you've got this trade. When you hit this 123.6, you have it going back against you. You have this trade going against you. So in order to mitigate these losses or potential losses, what a lot of traders can do, not saying that they will do, but they can do, they can make back this 91%. And think of that as a long position, even with 2x leverage. You're talking about 200% move with just 2x leverage. Okay, to long from 6,000 to close it at 12,000, that's significant, internal retracement, on the flip side coming back. All right, so what you would do, you would short this on perpetual. You would let this go ahead and come in your favor. Of course, be patient with this, and then you open up a long. Maybe you don't open it right at 6,000. That would be not ideal for you to get an optimal entry. This bottomed out right at $6,000. Who was expecting it to fall right to 6,000 right on the nose? A lot of people at this point were expecting it to just continue just falling. But nonetheless, we had a good bounce here, and this 123.6 to 100 range would have been a good area to enter a hedged long position. Now, here's where things get tricky. Here's where people end up just completely losing. Okay, they get this long position and it starts going in their favor, and they don't close it. Okay, a hedge position is not a position where it is intended to catch a market reversal. Okay, you caught the bubble pop up here. Hooray, good job. All right, so now what you're looking for, you're not looking for this 6,000 move to go up to 20,000 again. Okay, you're going to be looking to wait for this to show signs of exhaustion, which it did. You had two chances to get out at 11,500. Two chances to get out at that position to close your hedge, and maybe you closed it somewhere in here where it started to go against you, and that's okay, because that's what hedge positions are for. Hedge positions are just to mitigate potential drawback. Okay, so as this is going against your short position, you're going to be making money on the long position. And again, if you were trading on BitMEX, what you're going to be looking for is you're going to be looking to short on a perpetual, whichever one you are looking for the longer term trade. And then what you're going to be looking for is to long on futures contracts. So in this case, so today, for instance, you have the H20 contract, which expires in March, and then you have the M20 contracts, which expire in June. Okay, so personally, I would be trading, as from a hedge perspective, I would be trading the M20 contract. I would be short on perpetual. I would be long on M20. Okay, so this is basically how you would be setting up a trade from a hedging perspective. Okay, now again, this isn't something that I would recommend people just go in balls deep and just assume that they know what they're doing, because this is not something that an amateur trader should be doing, because you get this entry 6,000, it goes up here, you're up 100%, and you're like, oh my gosh, it's going to keep going, it's going to keep going. Well, then what ends up happening? It comes all the way back down here, potentially lower than where you entered, because again, you're not going to buy the bottom. It's almost impossible to time the bottom, and it is impossible to time the bottom every time. Okay, so maybe you got in up here. Maybe you got in at about 7,000 to 7,400. All right. Well, we come all the way back down here to 6,400. At that point, you say to yourself, oh, well, I guess my hedge is over. I'm just going to go ahead and close the position. Then you close it for a loss. That's not what hedging is for. Hedging is for scalping. You go ahead and take, it could be a week trade. It could be 2 weeks. It could be 3 weeks. You wait for this to go in your favor and you close that position. You don't continue holding it forever. This short that you had here at 19,000, that's the one that you hold until you hit your target, which again is that 200 weekly. All right, so now you get this hedged long position. You got to close that trade when you have decent profit. Because if you don't do that, well, then you're going to do this. You're going to end up, losing out. You had a 200% move up at 2x leverage, and then you just gave it all back to the market. That doesn't do you any good. That doesn't do you any good, and that's where a lot of people get lost. Okay, you take this hedge long, you let it come back, and again, I'm not sure that I would have taken another long position here. I would have taken this, I would have made that money, and I would wait to see what happens here. Because again, what just happened was you took this short trade, you're short from up here, and then you took the profit from this zone right here, which means, in my opinion, it would not be worth it to open any more long positions unless that price came back above 11,500, because you made that money. You made that money, you made that profit, and now you're sitting in a good position where you've made this profit on this drawdown up here. So you've made this profit and you've made this profit. All right, so you've profited in both of these ranges. And now you're just waiting for the breakdown. Okay, so maybe there's some opportunity on lower time frames to take other positions, swing trading, whatnot. You've got a ton of profit here at this point. Again, you're waiting for this move down here. You're waiting for a move to go further down. You're waiting for a move down to 3,000, right? And you've taken that trade from 6,000 to 12,000, or maybe a 7,000 to 10,000, whatever that may be. You made a decent hedged move there. Now you're just going to sit and wait. Okay, and again, you can take other positions, right? And if you're short from 19,000, let's say you're short at 19,000 from maybe you're at 5x leverage. Okay, your liquidation point on a 5x leverage at 20,000 is going to be something like $22,000 to $23,000. At this point, when the price is all the way down here, what you can do, again, this is more advanced, and again, I'm not condoning doing this. I'm just saying that this is something that people do. They'll increase the leverage used. So let's say you're at 5x leverage from 19,000. You increase that to maybe 20 or 25x leverage to increase your margin available, so you can do these hedge trades. Because let's face it, this position that you have up here at 19,000, this isn't going to get liquidated if the price is trading all the way down here at 9,000. If the price is trading at 9,000, it's got to go up another 100% in order for it to get even where you entered this position. Okay, so you can increase that leverage that you have on your hedged, no, sorry, not your hedge, your primary short position, to increase the margin available for the long position. Okay, but again, don't increase your leverage just because the price goes down $500, right? I wouldn't increase any leverage on the short position at the price of 17,300. I wouldn't increase it until you hit your target here for the correction and you are ready to hedge a long position. When you are ready to hedge that long position and that price is literally in your favor by what, 60, 70%? That is when I would be interested in increasing the leverage utilized, therefore decreasing the margin used on the short position to increase your margin available that you can do a trade on a long hedging position. Again, the key takeaways here are, if you're going to plan on hedging, you need to wait for that position to be seriously in your favor before you, one, increase leverage on your primary position, and two, enter a trade on your hedging position. And two, very important, when that hedge position is in your favor, you set a stop loss and you honor it. Okay, because you do not want to get caught longing here at 7,100 and then stopping out at 6,400 when that price was in your favor by 70 to 80%. Okay, because in a bear market, if you're making money on an uptrend in a bear market, you better take profit. Okay, one thing I want to look at before I go ahead and end this video, I want to talk about where we currently are right now. Okay, because this is important. Okay, so we were just talking as an ABC. So now if we take this bottom, I'm going to take this dominant pivot low to this dominant pivot high, and then we have our dominant pivot low here. And lo and behold, where did we reject? This is the reason why I am short from 83.50. This is the reason why I'm short from 83.50. And this is the reason why I tried to hedge down here at 77.50. I stopped myself out at 77.56 like a moron, and the price went down here just shy of 7,700, went to 76.75. I got stopped out, and then the price skyrocketed up back to this 81, 8,200 range. In my opinion, right now, if I had to guess, I'm saying that we're probably going to go up, and my short position that I took here at the 123.6 is probably going to get stopped out. But I'm hedged long here because I do have a little bit of a bullish sentiment right now, that we do have potential. We could come back up here to 8,800. So if we do, I'll stop out of this short position, and I'll go ahead and let my long position, which I have from 81.80, I believe. So not a very good entry that I have as of right now, because it looks like the price is moving to the downside here, at least for the last couple hours. I'll have to double check. I think my entry was actually 80.80, but nonetheless, it was basically I'm basically right where I entered that long position, because again, we had a good move up from from where I got stopped out down here, and we had a good move to the upside, and it looks like bottoms they're getting bought up. So my sentiment is we are probably going to see a little bit more upside, and I'm going to kind of wait and see, because again, I'm short from 83, 83.50. And so, I'm short from here in this range, and I'm long from down here, which doesn't give me a very wide margin, but it gives me an opportunity to catch a better long entry if we do happen to break up above this, which it looks like we're going to try to. Again, if we break down below 8,050, if we break down below 79.50, I think chances are pretty good we're going to go down to 7,500, which I will attempt to hedge long again down in that range. Again, use your tools that you've got, and just be very careful with what you are doing, especially when you're looking at hedging. Right now, it does look like 7,500 is very likely if we break down below this level here at about 8,050. So again, be careful. Again, hedging is not for everyone, and it does take practice. It takes time, and just be very careful with what you're doing. And of course, if this video helped you in any way, shape, or form, like, subscribe, share, all that good stuff. It was great to have you guys here. And if you have any questions, you can feel free to pop in the Telegram and ask me questions there, and also in the Discord. If you don't have an invite for that, throw in a comment and I can get you an invite for the Discord. One way or another, wherever you are in the world, hopefully you're having a good day, a good night, and a good evening.